So let's do chapter 17. So what chapter 17 deals with? It deals with the basis of financial analysis, financial statement analysis. Okay? Which is what the project is. So this is chapter 17. Okay? Now, and of course, this is the information that you need to do your project. Okay? All right. And I thought I'd do it now, just because if the things over Thanksgiving, like if 4 people need to meet, sometimes it's impossible to find a time when 4 you can meet, but if it's over Thanksgiving break, I bet you can find a time. Okay? All right. So, don't forget. Now the ratios, how you guys doing? All right, the ratios fall into these categories. So don't forget, the ratios, they can be liquidity and efficiency. Okay. Some deal with profitability. Some deal with solvency. And some deal with market prospects. And that's how you can sell your stock. Okay? So the ratios fall into these categories. Are they a measure of liquidity? Okay, like the current ratio and the quick ratio. Are they a measure of profitability, right? Gross margin ratio. Solvency, often this is debt to equity, but they're talking about, do you guys have enough debt? Is normally what the solvency. Is there too much debt? Is the right amount of debt? And then earnings per share and that sort of thing are the marketing prospects. Okay? And of course you take a look, it'll cover the balance sheet, income statement, statement of stockholders' equity, cash flows. Now, the standards of comparison. Standards of comparison. Sometimes they're intra-company. And I'm going to write CO for company and move along. And of course, intra-company, that means like it's a trend. Is it getting more profitable? Is it getting more liquid? That sort of thing. Okay? And take a look and see how you compare with competitors. You take a look and see how you compare with the industry. And of course, I've mentioned before, a great source of this, of course, is done in Bradstreet, because what they do is they have industry standards. And they break the industry down into quadrants and say this is the top quarter performers, the middle half, the lower quarter, and see how you can compare with other businesses in your same industry. And then there's guidelines. And the guidelines, for instance, a rule of thumb on your quick ratio. Remember, quick ratio is when you had liquid assets, like cash and those that are really liquid, compared to your current liabilities. And 1-to-1 as a rule of thumb is a good idea. And what that says is, if I have enough cash on hand to pay the bills that are due within a year, then I can survive an emergency, such as a strike or a national emergency. But that's an example of a rule of 1 thumb. As a general rule, the guidelines are probably the least reliable because it should change on your industry. Has everybody got the roll? Everybody? Okay, I'll put it right here. All right. And of course the tools that we'll do in here will be horizontal analysis. And horizontal analysis is comparing across time. And of course, what we're talking about here are trends. So when you guys looked up your financial statements, most of them had at least this year and last year. Some went back several years. But that's an example of horizontal analysis. Are they getting more profitable, less profitable? Vertical analysis. And what vertical analysis does is it, like in the income statement, revenue, gross revenue is 100%. and everything else in that income statement is reported as a percentage of it. So if sales doubles, everything else should correspondingly double on an income statement, and if it doesn't double, there's a problem. Because, and of course, what it tells you is you can have a lot of increase in sales, but if that doesn't turn into net income, it's pointless. So if your sales double and your expenses quadruple, that's a problem, and this vertical analysis will show you that because it will show all the expenses as a percentage of sales. And let me just introduce it now, and when we have an example, it'll be a little more obvious. And then, of course, the ratio analysis. And of course, what will happen this chapter, as the course has gone on, 201 and 202, every chapter had ratios, right? And so you memorized them at that time. Now, this chapter contains all the ratios. And the ratios, of course, are broken into these 4 categories. All right, and be sure to know what category each ratio goes in. So let's start here with horizontal analysis. Okay, so with horizontal analysis, let me put this up from you find this on page 690. And I'll go ahead and put it on the board and show you what an example of horizontal analysis looks like. So it's page 690. This is what we mean by horizontal analysis. And of course, it's across time. Okay. So, I'll put it up here now. I'll turn that camera around in just a second. And so, this here. I'll turn the camera around and turn the lights out so it's more readable. Now, let me move this around. Now, while I have this here before I forget, if everybody signed the roll.
What page is that on?
690, yeah, I went ahead and no problem, be sure to ask.
The numbers between,
What's that?
the numbers between the book and the certificate.
What did I put the wrong one up?
691.
Oh, 691. Oh, you're
Oh,
right.
there you go.
You're right. Let me do 690. Is that why you were asking? By the way, I've learned in the past, it's always a good idea to be polite. Because I'll admit, Levi, when you said that, I thought, hey, this guy read? Look, I wrote it down. I thought that, I'll admit it. But then I thought, no, Steve, all you care about is these guys learn their stuff, don't get bogged down and be pitiless. So I said, well, yes, Levi, look, I wrote it here. And it turns out I put the wrong one on the board. Am I glad that I had the maturity to act like that? You guys, that would be a lesson. I always act mature because it can really come back to be a blessing. Because I'll admit like that. Look, it's written on a damn board. All right. So, here's what it does. Now, what this is doing, now, by the way, the difference between 690 and 691 is the difference between an income statement and a balance sheet. So, and let me just put up one of each. So what you do now is you take this year, the previous year. So in this case, here we have 2009, 2010. So like cash and cash equivalents. In 2009, it was 835,546. This year, it went up to 1,550,861. So you subtract the earlier year from the later year to find the difference. So that means the difference is 715,315. Then you put the change, and this is the actual dollar amount, so the difference between this and that is this amount. Then you put this over the earlier year to get the percent of change. So cash and cash equivalents went up 85.6%. This is comparative analysis. It takes 2 years. It's a form of horizontal analysis because it shows how things change across time. Okay? And so they have a lot more liquidity. Now, don't forget you can be too liquid because What this might mean is they're not making the most of their assets. Maybe what it says is they should be buying some asset that they can put to work, okay? Now, it was interesting. My brother Marty works he's been a vice president type position for large corporations for all his life. He was somewhere in middle management, and then he's never been president of a national company, but he's been vice president of some really big ones. Anyway, what happened was this company just was purchased. And I said, does that make you a little nervous? And he says, no. And the reason it doesn't is because the company that bought his company, and he said, and it was, anyway, they did that as practice. So when he flies, because he's a big cheese, he gets to go into all these VIP lounges. So he was striking up a conversation with somebody there whose company had previously been bought by the same company that bought Mark's company. And what the guy said, as long as you guys are profitable, they'll leave you alone. Mark's company was profitable, they left him alone. Now, the reason it fits in our conversation is we took out the financial statements and started looking at his company because it was the profitability that was the issue. I saw the balance sheet and said, man, you guys got a lot, man, the company that bought you, it has a lot of cash. And he said, yeah, they're getting ready, this is before they bought us, they were getting ready to buy us, and that's why they had so much cash. Okay. But this will tell you, because that's quite an increase in cash, you just wonder what's up with all the cash.
Why have they reinvested?
What's it? Yeah, why aren't they buying something that'll make them money? Because cash doesn't make money, but why aren't they buying something that they can put to work?
Cash actually loses money, doesn't it?
Yeah, and inflation can eat it up. On any short-term investment like would be the cash equivalents, it's not making much interest. But again, what's with all the cash? Is the question you might, and again, there can be legitimate reason. Okay. All right, so that's a horizontal analysis. All right, so let's do this. So again, what you do is you find the dollar amount difference, put that over the first year to find the amount of change. Okay, this is what it looks like with the balance sheet. It's the same thing with the income statement. Okay, so this was the revenue in 2009, the revenue in 2010. As you can see, it went up. It went up by $3,888,038. Okay, but this over the first year, it was a 35.1% increase of revenue. Okay, does that make sense? All right, let's do this. Let's do a quick study. 17.5, page 715. Okay, here's how it reads. Then if you guys want to do that. So here's how it reads. What it says is, there's the top. So here they are. So what it is, all right, good. So here's how it reads. It says, compute the dollar changes and percent changes for each of the following accounts. So here's short-term investments. So you have 2010, 2011. So it went from 165 to 217,800. So find the dollar amount, put that dollar amount over the earlier year, and that will give you the percentage of the change. You guys want to do that? By the way, don't forget to be sure to convert the decimal to a percent by multiplying it times 100%. All right. How does that look for a set of answers? Begins trend analysis, or it's horizontal analysis, comparative analysis, and you're just comparing 2 years. You guys okay? Makes sense? Questions? Yeah, Tim?
So is it always going to be the first decimal? Like 0.3?
Yeah, again, there's no set things on this, Gavin, never said anything, it's inconsistency in that regard. I'd always carry it one page past the decimal percent. Yeah. In fact, it can be a problem, because on one test, I was grading it, the answer was 0.5, and then there were a whole bunch of answers that were 1. And then halfway through it, dawned on me, these guys rounded up. But one was so different from 0.5, I didn't recognize it. So then I went back and gave him credit. But yeah, there's no sense. All right, you guys doing good? All right. So now let's go to more horizontal analysis, but now it'll be trend. So in this case, let me show, let's show what you do with trend analysis now. And with trend analysis, what you do, it reveals pattern over periods. So with trend analysis, so the one with comparative analysis, there were 2 years, this year and last year. With trend analysis, again, it's horizontal analysis, but now what we have is it's the trend percent equals analysis period amount divided by the base period amount. Times 100. What you do now is the earliest year is the base period, right? So you find the difference between each year divided by the base period and multiply it times 100%. And so instead of just comparing 2, now you're comparing more than 2. Okay? Let me show you by way of example. So let's do exercise 17-3. You find it on page 716. Okay? And find it on page 716. Let me do the first row, and then you guys can do the second row. And all we're going to do now is find the difference between each year and the base year, put that amount over the base year, and then convert it to a percent, and you can see how it changes across time. So let me show you here. Let's trend analysis. Okay? So, let's take a look at exercise 17-3. Here it is. This is exercise 17-3. Oh, let me put down the screen. And again, it's horizontal analysis. Again, the earliest year is the base year, just as it was before. And now we're going to find the difference for each successive year. Okay? So, let me do this. So in this case, what we have here now is we have compute the trend percent for each of the following using the 2009 as the base year, as the earliest year. State whether the situation revealed by trend appears to be favorable or unfavorable. So in this case, what we have here, this is 17.3. So what we'll do is we will have, so for 2010, what we'll have is we'll have 235, okay, so we have 2, 3, 5, 5, 6, 0, okay, minus 151,000 divided by 151,000, and that turns out to be 156%. So when you do that with each successive one, it looks like this. So the earlier year will always be 100%, okay? Because it'll be 2009 or 2009. With 2010, I'm sorry, what you did, of course, with 2010 is you put this number over that number, okay? And this is the percent of increase, and up 1.5, okay? In 2011, you put this number over that number, and it's 168%, okay? So what it shows is that each year, for the first couple of years, it got more profitable, and then it leveled off for the last 2 years. And it's the year over the base year, times 100%. Yeah,
So for the numerator, when you took 235, 560.
I was mistaken,
Oh, okay.
sorry.
That's okay.
Yeah.
Wait, can you clarify that again?
Sure.
You weren't
What you want to
supposed to
do here
subtract?
for 2010, so what you do now is you put you put 235, 560 over 151,000, and you get 1.56 times 100, which is 156%. Yeah. I'm gonna make it smaller, so, does that make sense? So do you guys wanna, and then for 2011, what you do is you have 253,680 divided by 151,000, and that will turn out to be 168, that'll be 1.68, which would be 168%. That make sense?
So you just keep the base for every year?
Exactly. And every year, the earliest year will always be the base. And the reason that this will be 100, because it's the base over the base. Yeah, and wish this thing wasn't on tape. But right, does that make sense?
It does. Thank
And
you.
by the way, it's okay for me to do something like that because it's alert, you know, it's, if you remember anything, this is what you remember. So maybe I'm gonna leave the tape there. And of course, it just shows how it changes across time. Jessica, how you doing? you guys got for the cost of goods sold? Yeah. And then here's what it looks like for the accounts receivable.
This is called trending analysis.
And this is trend analysis, and it's horizontal analysis because it's cross time. Now, let's just take a look and see how this works out. So look what's happening here now. Sales are increasing, and then they kind of level off. But notice what's happening with their cost of goods sold. It's also increasing, but it's increasing at a faster rate. Because that must mean their profitability is down. And then when you look at their accounts receivable, which is money they have not collected, right? Well, it went up more, it went up more, it went up more. So this bodes ill for the company because sales are increasing, but their gross margin is down and uncollectible accounts are up. Here, let's see what the author says. The trend in sales is positive. While this is better than no growth, one cannot definitely say whether the sales trend is favorable without additional information about the economic conditions in which this trend occurred, such as inflation rates and competitors' performances. Given the trend in sales, the comparative trends of both cost of goods sold and accounts receivable is somewhat unfavorable. In particular, for the most recent year, both are increasing at slightly faster rates. The index for cost of goods sold is 198, accounts receivable is 199, compared to sales of 188. All right. So, I'm good. And then this thing about, you know, the competitors' performances and all that. I wish I could remember the name of the company. It was a grocery store. And it came in that they were losing money. And management was up in arms and ready to fire the store manager. Then when they took a look at the situations, their competitors were doing worse. And if anything, this store deserved praise because although they were losing money, everybody else was doing so much worse, they were doing an admirable job. So you got to take everything in context. This is across time. So you guys doing okay with that? All right. So now let's take a look. So what we did is what we did here is we took a look at horizontal analysis. Now let's take a look at vertical analysis. What vertical analysis does is it allows you to keep track of how things are changing. So let me put up an example to show you what I mean. So here's page 694. Let's see, page 694. Okay. And 694. Now on 694 is the okay. Let's see. Okay, yeah, that's right. Okay. 694 is the balance sheet, 695 is the income statement. So what's happening here now? I think it's easiest to see with the income statement because what's happening here now is the fact that, notice that revenue, so here we have 2009, here we have 2010. Notice that revenue is 100%. Now, cost of sales is 8,000, so what this boils down to, I'll get a marker here. So in this case, if you take 8,368,958, you divide it by 14,953,224, you will get 0.56 times 100 comes to 56%. So what it's saying is that cost of sales, and cost of goods sold is another name for cost of goods sold, is 50%, it was 56% of gross of revenue in 2010, and it was 53% in 2009. So what it means is they're doing a good job of buying merchandise. Okay? Now, then you do the same thing with your gross margin. So what happens here with the income statement is revenue is always 100%, it'll always be the denominator. And of course, it's 100% in 100% because for revenue, it'll always be over itself. Everything else, this is the numerator, numerator, numerator. So what you can see is you can see how things are going. So what this can tell you is the fact that, do you know how expenses, everything's getting more expensive, prices are always creeping up. You know how that works? Well, when that happens, what you do is you just get used to it. But things can creep out of proportion. So if you double your sales, like your other things should also double. But it allows you just to see, make sure that nothing's getting out of proportion. So in this case, in 2009, the cost of sales was 53, but I reversed it, but in 2010. So the deal is, they're not doing as good job of buying their stuff. And of course, the gross margin was down correspondingly year to year, year to year. Their research and development, those costs went from 6.2 to 6.5. Now the marketing got better. They got this cost down there. Amortization went up. Okay, litigation, okay, that went up. Income from operations, of course, went down. And then the investment income went down. Income before taxes went down and so forth. But what it allows you to do, it allows you to keep track of how everything is comparing within itself. And to make sure that nothing gets out of whack. Yeah.
So you're saying in this scenario, then, if you wanted to compare gross margin to cost of goods sold, that's what you'd be comparing on a vertical analysis?
No, what this is saying is the fact that in 2009, your cost of sales, which is the same as cost of goods sold, was 53%, 53.9% of revenue. And it increased to 56.0% of revenue in 2010. So what it means is they're paying more, they're paying a higher portion. And of course, then if your cost of goods sold goes up, then your gross margin will go down.
How are you showing that?
Well, in this case, your gross margin was 46% of gross revenue in 2009, and it dropped down to 44 in 2010. So that's what this shows. But of course, it would make logical sense, because in this case, normally revenue will break down into cost of goods sold and gross margin. So this plus this has to equal that.
Right.
So if this goes up, this goes down. Tim? Michael, before I go on, does that make sense?
Yeah, no, that makes
Okay,
sense.
yeah, Tim?
So basically, all the numbers coming down under revenue are numerators, and they all get divided by the revenue to get the
Exactly.
percentage.
Mm-hmm. Exactly.
Okay.
Mm-hmm.
And then certain ones have to add up to.
That's the only one that does it.
Yeah.
The other, it doesn't hold true for any of the others. And it just holds true for those the second and third one down, simply because of that, but that won't be true of any of the rest of these. Yeah.
And what does this ratio tell you?
Well, it just shows what it is. It's kind of the idea that it'll tell you, for instance, if your sales double, your expenses should correspondingly double, right? So if you sell twice as much, but that's hard to tell when you have odd numbers. So in this, and of course, it's hard to eyeball. So what you do is you take each of the items in an income statement, compare it to gross revenue, and we'll see how you're doing year to year. Again, let me back up, I don't think I'm clear here. It's the idea that any number by itself is simply hard to make sense of, right? So when you get this, let me get this. So when you get this number here, so when you get this $8,368,958. It's just hard to make sense of it. Well, here's one way of making sense of it. You compare it to revenue, okay? And so what happens is cost of sale, cost of goods sold was 53.9 in 2009, and then it went up as a portion of revenue to 56 in 2010. That means that you're not as efficient in buying. And that would have been hard to tell just looking at the raw numbers. So it means that you're just not, this, if this is an expense, expenses went up as a portion of revenue. So as a portion of revenue, they went up, and of course the expenses go up, then your gross margin will go down. Of course, this is cost of goods sold, which is an expense. Yeah. And so what it means is, you gotta, if you own this company, you'd say, what's with the purchasing department? And it's just like, not exactly a red flag, but it's something you want to look into. And of course, yeah. Does that make sense? All right, you guys doing good? Okay, let's practice this a bit, kind of get it down. And then, by the way, both the comparative analysis, the trend analysis, and the common size, the vertical analysis, all of those are menu items in most computerized accounting packages. So if you have QuickBooks, you can tell it to display the income statement balance sheet with this data on it, so you can see how your business is doing. And that's the beauty of a computerized system, is information that would have been tough to get before is now instantaneous. Michael, do I see a quizzical look?
Nope.
Okay, all right. So let's do this. Let's do exercise 17.5. By the way, I had my notes here for me to do 2010. You guys do 2011, but I don't think that's necessary. You guys are pretty sharp. I'd be glad to if you want me to, but I think,
What exercise?
right here, exercise 17.5, page 17. So exercise 17. So here's how it reads. So here it is. That's quick study. Okay. Here's exercise. So here's exercise 17.5. Okay. Express the following comparative income and common size elements. So what it will boil down to is sales will always be the denominator. These will always be the numerator. And it will show you how it's working. So if you guys started with 2010, does this look like a good set of numbers? Feedback part of the way through? Yeah. Jonathan?
So for the second, the 47.6, how do you get that again?
Well, what you do now, in that case, you put 254,660 over 535,
Now you're using 47.
and that should give you 47.6.
Then how do you get the 52.4?
Then it's this number.
Okay. Oh.
So
okay.
here's a
Okay.
pattern.
I get it.
This will always be the denominator,
Okay.
and each of these will be the numerator. And then it's 100% for the first year because the same number is both the denominator and the numerator. And again, all you're doing is you're just putting these things in context, because any number by itself just doesn't make any sense. Yeah, yeah.
This is called vertical analysis.
In vertical analysis, and another name is also called common size.
Common size.
And by common size, they just have, it just means they have a, the common size in this case. All right, does that look like a good answer? So here's how they interpret this. Overall, this company said, so here's what we have. So sales is always 100%. Now, cost of goods sold went from 52 to 66, and that's more expense in proportion. And of course, gross profit will be 47 and 34, will go down correspondingly. The other expenses, they also went up, and therefore the net income was less than half. Okay? Overall, the company's situation is worse. This is evident from the substantial decline in net income as a percentage of sales from 2011, 13% relative to 2010, which is 28.2%. The main culprit is the increase in the cost of goods sold as a percent of sales, 54 and 66. On a somewhat positive note, the company has not experienced as large an increase in operating expenses as a percentage of sales, okay, 19% in 2010 versus 21%. Even more positive is the company's level of sales increased from 535,000 to 720. Okay? And again, you know, they've gotten larger, but it's that they sacrificed efficiencies in the process. Maybe it just takes a, maybe it's just the cost of growth, who knows? It's doing good?
I have a question.
Sure.
How come when you add them up, they add up to more than 100%? Is it because, let's say, profits could include some of the other categories in it?
Let's take a look here. Why would that be? Now, of course, these lines 2 and 3 have to be reciprocal. Well, here's the deal. These two lines add up to 100%.
Okay.
So if you took this, let me just put it, this plus this would be 100%.
Okay.
And then you add that to it, it would be more than 100%.
Yeah, I know, I just don't understand how it can all work together, because you have a certain amount of money you're looking at, and you're trying to find what the percentage it is, so it makes sense that the numbers would all add up to 100.
Your points were taken 10, yeah.
I was just saying, I don't know if it would work that way every time, but the net income plus the operating expenses will equal the gross profit. And the gross profit plus the cost of goods sold will equal the 100%.
Mhm.
Okay.
That's true. Let me stop and think about that. So if you have gross profit, yeah. Wait a minute. Oh, yeah, I see what you're saying. So this plus this, where do you get the 100%? Because this would be.
Those two equal the gross profit of 34.
Right.
And then if you take the gross profit plus the cost of goods sold, that equals the 100.
Okay, I see what you're saying. And again, the way that'll work is this minus this equals that. Therefore, this plus this would equal that. It will always work. Yeah, because if this minus this equals that, then this plus this would equal that. Yeah, no, Ted, you're right in the money. And nice, yeah. And again, but again, the way you're, let me kind of go back. The way it works is this minus this equals that.
Mhm.
This plus this equals, so these two together will equal 100%.
Mhm.
Does that make sense?
Yeah, that makes
And when
sense.
those two together equal 100%, then when you add anything else, it'll be, it'll exceed 100%.
Okay, so basically the categories aren't, they're being used twice, like they go into each other.
Yeah,
They
there's
intermingle.
there's some complement, there's some complements here,
Okay.
right? And complement means that they add up to one.
Okay.
So these two are a complement, right? And then this plus this will equal that, which again is half the complement.
Okay.
Yeah. Okay, all right. Now, what we did is we dealt with an income statement. The same thing happens with a balance sheet. So if we have the balance sheet here, I'm gonna put this back here so we don't start mixing up these papers. So this was on page 6, so let's go to 695. So 695, except now the total assets is 100%. Now, if we take a look at the, so now it's, there again it's common size, and again, all you're doing here is you're trying to put things in a perspective, right? Because any number by itself just doesn't make any sense. So in this case, total assets is 100%, so this will always be the denominator. And of course, total liabilities and stockholders' equity will also be 100% because it's the same number, right? Because your total assets, 10,204,409, is the same as total liabilities and stockholders' equity, because assets equals liabilities plus owner's equity, right? So, total assets will always be 100%, and the total stockholders and owner's equity will also be 100%, because this will be the same number, because in each case, it's the denominator, and for that one, it's also the numerator. Does that make sense? Does that make sense? And so now everything else is the same. So your cash and cash equivalents, it was 10% in 2009. It jumped up by half in 2010 as a portion. So